Welcome back, everybody, to another episode of Loan Officer Life, Hustle, Heart, and Home Ownership. Bruce, this is getting to be old hand. You're like a three-time returning guest to my little podcast. Thanks for joining.
Well, opportunity to talk, and I know we've talked in the past. I think we have good conversations, and it's a great opportunity for us to share a little bit about what we're seeing in data that we're constantly out there now all year round gathering. So I really appreciate the opportunity.
Yeah, this is a first for me to be able to kind of talk about what JD Power is seeing specifically in this 2025 Mortgage Origination Satisfaction Survey. And I think before we hit record, you told me you're about 75% or so way through the study.
Yeah, we collate into waves, quarterly waves. So we've got 3 of them in the can as it were right now, and we're just finalizing some of the analysis that we're doing. We really don't do the deep analysis until we get all 4 waves in. We're doing a little bit better with sample this year. We should have over about between 10 and 11,000 completed responses by the time we get finished. So It's been a challenge for us lately in our methodology with just the volume in the industry.
Yeah.
But it's really turned around. We tweaked a few things, took a little bit different approach in a couple areas, and it's paid off. So we're starting to see, have enough numbers in there to start to see some trends and see what's up. Basically.
Yeah. Well, I want to get into that, but before we do that, for those that maybe are coming on a little bit late to the scene here, Bruce, tell us a little bit about JD Power, and then specifically how JD Power works within the mortgage industry in this particular segment. I know a lot of people know the name, know the brand, JD Power. I'm from Detroit, so I happen to know them. And so just share with the audience, real quickly, who JD Power is and how you all are helping our industry, but other industries as well.
Yeah, JD Power is focused really across all industries, and this includes the auto industry, which there's a lot of recognition there, but we do all kinds of consumer-based studies across financial services, banking, credit cards, auto loans, things like that. But even outside of that, insurance, health insurance, and all kinds of different areas. And really, it's focused on the voice of the customer. And really, simply stated, we try to give a microphone to the customer and let them tell the story. So they'll report about their experience with their providers, product provider, service provider, whatever it is. So we're not taking a position anywhere in this. And the idea, JD Power has been doing this for over 50 years and has a lot of experience in taking objective third-party external research. Basically, we're not going to anybody's and looking for anybody's client list. We develop all this on our own independently and anonymously. So it is truly objective research. It is done in this sense. When we look at mortgage origination, we're anywhere in 12 months from a closing out. And that's one of our screeners. So our studies are driven by market share. So we're looking at the largest 2/3 of the industry. So the big players, basically.
Yeah.
And we focus on retail only. So we use Inside Mortgage Finance and their numbers to try to sort through between correspondent and other third-party originators. But our idea is the consumer identifies who they went to for a loan. And if that happens to be Rocket Mortgage, or it happens to be, Loan Depot or Rate or anybody else, that's who they're going to report on. And so it all comes back to the customer and their perspective and what they see and what they feel. And the only real difference I would put out there is a lot of times what we see is a little bit different than what customers see in their primary research that they do with their borrowers. Most folks do a post-closing survey. They get some great feedback directly about somebody. They can tie that back to an actual experience, what went on, where they came from, what their real demographics are. We can come in anywhere between that, 2 weeks after they close to, 10 months after they close. You get a very different perspective looking back sometimes than you do post-closing. The other thing that there's a little bit difference in sampling, it's called self-selection bias, we come into this neutrally. So nobody signs up to take, a survey on Loan Depot. They sign up to take a survey about mortgage origination, and then boom, all of a sudden they're talking about Loan Depot. They're not motivated by a particularly great experience or particularly poor experience. So you get those two often in that post-closing survey. A lot of times the people in the middle are busy. They're just not that motivated, and they don't have a lot to tell you, and they kind of pass it by. So it's a different look. It's not better. It's not any worse. It's a different look, and it really picture what may be going on, in your customers, basically how they're perceiving you as they go away from that experience.
Yeah, what I love about the survey, the output is, set aside the brand. I love the kind of macro view of what this consumer's thinking about in terms of their experience as a cohort, right? And I know last year, late last year, we got on here and we talked about kind of what you saw fresh out of the 2024 full study. That was like, I think in early December, you and I did that one. So guys, if you're in our podcast page, then you'll see in this link, the link to last year's episode. I recommend you go check that out after this one. Because you can get a little compare and contrast to what was in the 2024 data, but with 3/4 of or 3 waves of 4 in the can, as you said, what are some of the things that you're kind of seeing so far? And is it consistent with how we exited 2024? Maybe reinforcing anything in particular?
Yeah, I don't think, we're not seeing a huge difference between what we saw in 24, but a little bit more so. I think what we're seeing is some of the numbers have ticked up. We've talked a lot about engagement, where it happens, what time, when buyers, and we have primarily buyers in our study now, because that's who's in the market, when they start to think about borrowing and when they start to think about buying a home or home ownership. And that conversation is happening earlier and earlier, as we talked about last year. And we see that ticked up a little bit more. The other thing we see in that is that younger borrowers, and in our data now, we're seeing about 2/3 to slightly higher, getting close to 70% now of it, is millennials and Gen Z buyers. That's who's in there buying, and they're even a little bit earlier. So we're getting 1 out of 2 of that cohort is engaging with a borrower before they even start to look for a home. And a lot of that, to be honest with you, is happening with the bank lenders. So the depository lenders, the lag there is with the IMBs. They're not quite as engaged earlier. I think it's a tougher hill to climb for them, because those banks have that built-in customer base and they're familiar and things of that nature. But the numbers are increasing, and there are a couple outliers, at the brand level that do a good job of that.
Yeah.
So that's an interesting thing that we're seeing. The other thing is some of the differences between how that younger cohort, if we take the millennials and Gen Z and put them together and compare them back to Gen X and boomers, they're very different, and that is growing. So that digital native part of it is starting to become more apparent. They're more active on mobile apps. They tend to go to the website earlier in the process. How they find their lender is more often than not through research and recommendations from friend, family, and colleagues. Also real estate agents in there as well. Not quite as much as some of that older cohort there. So you've seen a little bit of shift there. Also more social media users. So we're seeing more of that in that earlier group. And if you go to Gen Z, the numbers are fairly small, so I don't want to get too far into that, but Gen Z is much more focused on social media than the other generations are. Yeah. So I think going forward, that's really a place where folks who are building a business longer term need to be. But that's something that's starting to show, and it'll be interesting when we get all the data in to look to see what's happening there.
So let's double click a little bit on this idea that for the first time in the 2024 data, I saw, how evident it was that there has been a shift in consumers, especially home buyers, engaging with the lender first before they started the search process. And it sounds like what you're saying is that trend not only has continued in the 2025 data, but it's actually even a little bit more pronounced.
Yes.
But you brought up a good point, and I want to really make sure the audience understands this. So far in the data, what you said, Bruce, is that the banks are kind of winning in that particular space, right? And it makes a lot of sense from an intuitive perspective. They already have the relationship. Probably mom and dad set up their bank account for their child. When they had their first event where they started getting money for a first communion or a graduation or whatever the heck it was. And so it would make sense that the banks would maybe have a leg up. But I want the audience, who's probably going to be mostly loan officers from IMBs and brokers, not to be disheartened. I would pay less attention to the brands and the type of brands that are winning and more to the activities that are happening. And I think that Bruce is what gets me so excited about the loan officers that lean into this data and then study it and then actually execute on strategies that they know are working because your data says it's working. How would you, if you were in front of a group of loan officers, which you kind of are on this podcast, how would you coach loan officers based on what you've seen so far in the data to, what would you tell them that they should be focused on? Not so much all the tactics around be on this social platform or anything like that, but like what could they be doing today to show up in next year's study?
Yeah, it's a great question. And I think the more that we see when I think about this and a little bit of my dark past is I spent some time as a loan officer way back when. So in my time in the industry, I was actually out there on the street too. So I kind of have a feel for what it's like, but to me, it seems so different now that, if you tried to do that the way we used to do it, which was really walk up and down the street and bang on real estate office doors, that's just not going to get you anywhere. So I think that's something to, definitely still pursue. This isn't going to change completely overnight as things seldom do. But the other thing is, I think you need a multi-channel approach to this, and you really need to establish your own presence. I think IMBs need to do that, but also loan officers need to do that independently. I mean, for loan officers running, for all intents and purposes, their own business, right? So they need to create these different channels, whether it's social media, and to be able to get a feed of these earlier leads. I think it's going to get tougher and tougher if we just look at what's going on in the industry. Not that they're, Rocket and Mr. Cooper aren't going to control everything, and Zillow's not going to lock down everything either, but it's going to, compete, and it's going to narrow that available pool of what's out there. So it just makes it a little bit more difficult. I think what the banks have done, and we've seen this, is they've focused internally. So they don't chase every lender, every borrower anymore. They're looking to keep their business to their customer base. And you're going to be able to peel those off if you can get, I think, you get that independent presence, because that is really where we're seeing some advantage. The other thing that we've seen kind of creep up a little bit is this reliance on the lender to really take me through the process and really to be an advisor as how to get through that. And that we're seeing that even grow a little bit stronger. So that percentage is growing up, and it's been up each of the last 3 years. So there's a perception out there that the lender's representative, the loan officer, is really ideally suited to help me understand this. And I think that naturally can be extended out to other parts of buying a home. You don't have to be the expert at real estate, at the market and things like that. But when you create that independent level of advisory, there's a trust there that they're going to come back and bounce questions or ideas off of you. And once you get there, I think that's the sweet spot to get into, because it's very hard to, I was having this discussion with somebody else the other day, actually with Dave Savage, so about pricing. And what we see in the data is pricing doesn't really differentiate. It still is a really important factor when people choose lenders, but what it is confirmation.
Yeah.
So what they're doing is there's so many opportunities to get an idea of what the price is out there, what the rates are. Back in the day when we talked to a borrower, the only way to really know was to call up a couple of lenders, right? And get some quotes. You don't really need to do that. And the data shows us that borrowers aren't doing that. So they accept that first one, mostly because they trust either their referral or that initial relationship. And those two things really stand out. So building that relationship up front is critical, because you don't compete as much on price then. You're competing on these other elements where you're differentiating, because everybody, for the most part, is within a few basis points. I don't think anyone's out there throwing something out there that really buys the market. Maybe somebody comes in a little bit lower once in a while because they want the volume, but I think you can't sell on price.
Right.
You're selling on that service and that positioning yourself as someone who should be trusted, who's a source of independent and objective, information.
So last year, another piece of data that I thought was just fascinating was when a consumer engaged with the lender early, however that's defined, earlier in the process as opposed to at the point of sale. So we'll use your term that I stole, and I'm going on the record. I'm going to say it again. I stole this from you. When it's a point of thought engagement versus point of sale.
I think I stole that from you, though, by the way. So
it's all right. We can borrow it back and forth. When that consumer started at the point of thought engaging with a lender versus waiting, contract in hand. Now I got to go see my lender. Tell us about the difference the data tells you in terms of how frequent or infrequent that customer shops when it is time to transact.
Well, we just I have some data I pulled here just so I'm talking accurately here. Satisfaction is higher, but trust is even higher than satisfaction. So you're at about 15% higher in trust than you are, and a little bit more in satisfaction. This recommendation. So what we're seeing is a higher percentage. Just go back to that younger cohort, and they're relying on referrals and recommendations. So recommendations are critical out there, because if you did business here, that can grow into 2 and 3 different loans. Recommendation, that is what is it? 29% higher. So almost 30% higher when they're coming in earlier. And they're 31% more likely to submit a second application if they come in at that transactional point. So you got that 30% benefit to recommendation if you get them earlier, and you got a 30% hit basically if you're waiting to layer, because at that point they may put in because it's a transaction in their mind, and that mentality is still there. So you want to create a perception that this isn't a transaction. This is an advisory interaction. This is what, for instance, a successful wealth manager would do. We're not here just to trade stocks. We're here to help you build wealth over time. And that, I think, is a great perspective in how you do it. You come in, there's so many, credit apps now. Every bank credit card has a way to check your credit score, but not that. And they'll tell you this app, this behavior, that behavior will help your credit score. But leave people on their own, and it just doesn't go anywhere consistently. And that's where having that hand holding along the way, I think, really helps and creates that environment. The other thing too is we started collecting data about people who've actually come back. So we ask about, would you? And we get some feedback on that. But we've got data now on people who did, and that number is significantly higher. Let me see if I can find that. it's 133% higher of a return to that last lender when you come in at that early moment. So it longer term, I mean, you're building a business for the long term. This is how you want to be doing it. You don't obviously close yourself off from other sources,
Right.
because if there are transactors out there, you can transact too. But thinking long term and thinking how these trends actually start to move, in greater and greater percentages, which we're seeing, that's where you want to be. And now's the time to get there. Is basically what I feel is.
I think about this like nonstop, right? Because it's part and parcel to what we developed at FinLocker with our app. And so I want to hit on a couple things for the audience to really understand is like from a technology perspective, what Bruce is saying is that there's a ton of stuff out there. I can go into the app store right now and find 12 different apps to see my credit score and signal model changes to that score, et cetera, et cetera. I can go to another dozen and get budgeting and goal setting tools, all that stuff. I can go to Rocket Money if I wanted to right now and have a great, PFM personal financial management tool and be in that ecosystem. And so when we went about building our technology, we didn't feel like there was room to compete with those direct to consumer brands that already do a great job. And I mean, I'm a user of a lot of them already. What we set out to do was build technology that would touch the consumer, but through a lender and through a loan officer, knowing that at the end of the day, that loan officer who's on the street is somewhat competing for attention with these other apps that are out there, right? And so all of this data that you guys that you're sharing on this podcast today, that's kind of the sneak peek of the 2025 study, is reinforcing. It should be reinforcing for our audience that the long game does win if you're willing to play it and invest in it. And the long game could be 3 months with a consumer helping them get ready. It could be 3 years. But all the data that you're pointing to shows that not only does it work for that single transaction that could occur at the end of that first engagement, but it sets the table for the next transaction with that consumer. And equally important, sometimes more important, for them to recommend you to their friends, their families, their sphere.
No, that's a great point, because that's a so-called, viral reaction that you want, because it's going to grow somewhat exponentially as opposed to one-off. And I think your point about having a guide is important. We're publishing our servicing study next week, well, to our clients, and publicly the following week. But one of the big issues in there, so much of the capability that's been developed by mortgage servicers goes unused.
Yeah.
And it goes unused because it's just left there. And some of it's very effective. You take a walk through what it does and what it can do for you and help educate you about, say, escrow management or something. And it all works really well. But 15% of the customers use it.
Right.
And because they're on their own and people are busy. And so I think your point about having that guide to walk people through, not only does it help them use it properly and know, what it's for, and really, because you let people, with consumers, if you leave it in their hands, what we see time and time again across all this consumer data is that usage, that effectiveness, that adoption profile just tends to disintegrate over time.
Yeah.
So if you're not there and you don't have to overwhelm them,
Right.
but that relationship is important, and it's a tool to build the relationship, because it does two things. It educates, it gets people's behavior going in the right direction, but it creates that relationship, which is ultimately what you want. And that's the business that you're in. Because I think with all these tools, and we've heard a lot about this with artificial intelligence, but the business you're in is building relationships.
Yeah.
Right?
Yeah.
And so use these tools to do it, but don't rely on them to do it on their own, because then you become just like somebody else. There's no differentiation in that.
and this is going to sound, sabotaging to a degree as a technologist that serves the mortgage industry. But one of the things that drives me crazy when I talk to originators is when they say, I just want automation that's going to talk to my customer for me and do this for me, all the stuff, right? And I'm like, yeah, but that's just like everything else that's out there. Then how are they gonna remember you if you're never in the loop in that process? So like I'll say, I have nothing against CRMs. I think they're absolutely great. And I think they're necessary, but I wouldn't rely on a CRM to be my only point of contact with my database. Just like I wouldn't rely on the FinLocker app to be the only outreach and touch point for me with my customer. Those are tools to scale your presence and your service to your consumers, but nothing replaces this, right? Nothing replaces getting face to face, whether it's digitally face to face or belly to belly, as they say. That human in the loop is so important, and your data shows that every time.
And we see that across multiple industries and services, especially in financial services. A lot of what we've seen, and I've talked about this before, with younger borrowers, is there is this preference for digital engagement. So yes, there is this digital native kind of approach to things. A lot of people just don't want to talk to somebody.
Right.
But at the time, if they don't feel that this is working, they do want that connection and
Right.
they do want that relationship more so than some of the other borrowers. And we see this in our wealth management studies. We've published some of that data, and we see this in our mortgage origination studies too. So they have a higher preference for an old digital loan. Like, hey, this would be great. But you know what? In my estimation, and I'm speaking as them, this isn't really working right now. So what I want is somebody to talk to me. And I'd like, and it's either face to face or it's like this.
Yeah.
So we ask about these video conferences and calls, and very few people use them, but they derive a really great experience and people react well to them. So it's not something I think people should shy away from. It's something, if you're having that conversation, why not do it like this? If you can, because it creates a bond. It definitely does. We see this in the data. We talk about this because the capabilities are out there, especially post-pandemic, right? And a lot of people are comfortable with this. Some people may not want to do it, but it is something that really drives a great response. And it's fill the gap where the gap exists. So I think your point is really valid about the relationship. These tools help you scale by taking those non-relationship building activities and handling those efficiently. But the relationship building things are still important, and that's not going to go away. Well, maybe at some point, but I can't foresee that, anytime soon. And that, because a lot of preference, we've have some preliminary data on artificial intelligence. There's not a lot of trust there yet. So if you're relying on that for outreach, that's something I think you have to be careful with, because there's a grave concern about so-called deep fakes, fake phone calls, and you may get a negative reaction to that. And we're asking now going forward more questions about this. I've seen some other data about, if I knew this, I'd go somewhere else kind of thing. And that's pretty severe. So we're trying to confirm some of that, but this is an area to wade into carefully. I think the stuff that goes on in the back office and things are great.
Yeah.
But we're talking about building, longer term relationships and relationships that can lead to other relationships. And I think that's still done face to face.
Yeah. I would have a hard time if my business was, originating loans with consumers. I'd have a hard time handing off some of these significant conversations to an AI, to bot, to anything. To me, it's too important, and it just leaves too much. It just puts too much to risk. It's out of my control now as that professional. So Bruce, you and I chatted last week, and I want to put this out to the audience. Hopefully it's helpful, but you had mentioned that you're interested in understanding what loan officers would like to see in the data going forward. So as you kind of think about the next couple cycles of creating these surveys and putting them out, you know, what would loan officers want to know in the data that would help them serve their consumers better? Do you want to talk a little bit about kind of what you're looking for there?
Yeah, what we're seeing more recently is, especially at the brand level. So we see the higher experiences really coming from those lenders that are driven by a more personalized relationship. A lot of loan officer driven things. There tends to be more variability year over year because there always is in human behaviors. And there's some things about process and things of that nature. But basically, this I think, and I think that in my opinion, and it's backed by some of what we're seeing in the data certainly, is that loan officer is not getting less important. I think they're getting more important, especially as technology becomes more and more prevalent here. I think it becomes more and more important to be handling that process and that role properly. And traditionally, a lot of JD Power studies focus on process, from the perspective of just how it appears to customers, what they do, how they go through this journey. But at some point here, we want to capture more of this part of the journey, which is where you're getting guidance. And we've asked about that in the past. We're adding a lot more there about that. But what can and what should loan officers be doing now? And I don't particularly know that. I know some of what we see in the data, but we want to be asking borrowers, the right questions about the right parts of the relationship and their journey so that we can give some, insight into how to really fine tune that part of the relationship. And I think that's going to be more important. And it sounds odd to say that than it has been in the past, just because you've got big platform moves out there, right? Yeah. And they're going to have people involved too, and everybody's trying to tweak that and find the right message. But if you're an independent and if you're a local loan officer, you've got to figure out how you're going to compete. And I don't think it comes down to just doing what you have been doing, but only doing it better. I think you need to be better, but you also need to look at this differently. What we're really trying to do here is get some insight as to what the consumer wants to see from that role, and get a sense of that. And it's always, for us and for me, one of the reasons I love these conversations is to get insight from folks who talk to loan officers all the time and who are in that side of the business and are seeing what's going on, because we're spectators really, and we're picking in there and trying to really come up with what's current, because what mattered 2 years ago doesn't matter as much now, and we're seeing some new things come through as we've been talking about.
Yeah, I geek out on the data every year, and more so since coming to this side of the business where I'm serving loan officers through our technology, and so I just appreciate everything that I appreciate your willingness to be so available to us as an industry. I know I see you with Dave Savage. You and I have done this. This is our third time doing it. I think you were on the stage at Housing Wire, if I'm not mistaken. So it's great to see you kind of get out there and spread the word. If you're a loan officer out there and you're not paying attention to this data, you need to. To me, it's the macro playbook, right? This is what the consumer at large is saying, and they're not saying it about you necessarily, but this is what they're saying and what they're feeling and what they're thinking. And the smart loan officers who are thinking about their future are building strategies today based on what this cohort of consumers is saying in real time. And that's what's cool about you coming on here and 3/4 of the way through your process to kind of, again, share some insights for our loan officers so that they can start doing things today that are going to impact their business next year and beyond.
Yeah, I mean, it's something that's relatively new. Last year was our first full 4-quarter study where we were out there all year long, and something we started in the middle of 2023. So since we started doing that, we've traditionally, as a company, been very tight with the data.
Yeah.
It's a business model. You want it,
Yeah,
you
yeah.
pay for it, kind of thing. But this industry data, I think, is very interesting to folks, and part of the original vision of Dave Barrow when he started the company was to help the consumer, bring the consumer up, improve
Yeah.
experiences for them. And I think we don't work with that. Obviously, we don't work with everybody, but if we can put some of this general, industry level data out there and say, hey, we're seeing some trends, and it does help and drive this, and folks like yourselves and can take this and make it make sense, then that's a win for us as well.
Right.
And the other thing does is this highlights other parts of data that we do have
Yeah.
that traditionally folks just say, oh, it's all about satisfaction. And honestly, I spent 12 years in the industry, and what they used to think back then, and I don't think it's that uncommon today, is there aren't any problems that can't be solved with a couple of new loans, right? So it's such a sales focused industry that satisfaction a lot of times takes a back seat to that. And I understand that. I get that. But I think we've got more and more of this decisioning process, what is really going through borrowers' minds, why they do what they do, what resonates with them, what are best practices if you want the best relationship with them.
Right.
And so we're trying to add that back onto some of the other things and the brand image elements and things that we also collect. And a lot of our clients don't even know we have this.
Yeah.
So, and they're not using it because they're so focused on what they've always done. And humans tend to stay within our our little known world.
Yeah.
And we're trying to break this out a little bit. This is the first year, really the first full year, that I've been sort of in the role of being in charge of these, and I'm trying to get this out there as much as possible, because I think we've got something worth sharing.
Yeah,
and whether
100%.
we sell a subscription or not, this is valuable to us, and it's valuable to me and how we build our business going forward.
So I was gonna let you off, but I got one more thought, because I think this is important. And you brought up the Rocket kind of ecosystem, right? So Mr. Cooper, Rocket, Redfin. I think it's a brilliant play. It makes all the sense in the world to me. And I heard Bob Brooksmith on stage talk about this. Too many people are focused on, woe is me. Look at what they're doing. That's going to hurt me. And Bob said, that's post close on Mr. Cooper Rocket. That's 1 in 6. He's like, guys, there's 5 and 6 transactions still out there to win. And this is what goes back to your data. When you engage with that consumer, and let's just say that first time home buyer, when you engage with them early in the process, I think you said they're 133% more likely to come back to you, even if it ended up in that other ecosystem. So there's like this long game. Yes, it's a long game, but it has fruit at the end of this thing. It's worth it for you to do it. It's how you can build a sustainable business that can outlast some of these, these big ecosystem plays that are out there.
Yeah, I think that's a great point. They're not, and the thing about the mortgage industry, if you look at it, it is so fractured to market share. I mean, we're capturing, by our calculations, about 70% of the retail lending market share, and it's maybe 32, 34 brands. But from there's thousands of lenders,
right,
and they're all finding a niche and a way to do it. And yes, there could be a challenge for the guys in the middle here, from this, but we don't know that yet.
right.
And, we're not throwing up your hands and saying, I can't compete against that. I worked for smaller companies that grew into mid-size, independent mortgage banks. And we were always able to outcompete larger lenders just because we were more agile and nimble, and we could do things on a more personal level. I think there's more challenge to that now than there was, but there's still the availability to do that. And I think, what you're talking about is moving this interaction further and further up that funnel, is where you know, strategically, you're going to help because they're doing it at an industrial scale.
Yeah.
And we've seen rockets scale at other things. How successful, we don't know. But if I was a real estate agent, I'd be wondering, you know, looking at how I'm doing, getting my leads as well. So,
Sure.
you know, there's a lot of potential change. Obviously, we're not going to see things overnight, but it's a competitive business, and it's always been a very good business to build your own business. I don't think there are too many other areas where you can do this without a lot of overhead and, you know, upfront costs if you're willing to put in the time and the effort. And I think if you're not looking at data these days, you're going to have a tough time, whether it's your data, but know what it is. There's a lot of data out there, but know what data is. Is it quality data, and how do you interpret it? It's not so much the data, but it's the insight you can gather from it that's important.
Always, I always leave these like in my head with, oh my God, I should have asked this question. I should have asked that question. So we may have to do another repeat in a few weeks after this one gets out, because I'm sure this is going to get a lot of attention and a lot of feedback. But Bruce, I appreciate you taking time in the middle of middle of the summer and in the middle of the survey to share some insights into what you guys are seeing. It is so important, the work you guys are doing. I've been a fan for a long time, going back to my past life. And again, just appreciate your insights and your time today.
Well, like I said, I love the opportunity to talk. We've always had great conversations, and I'm more than happy to do it. And it's a great opportunity to us to get some awareness to what we're doing out there and to get some feedback. If folks can come back and, you know, I hear more from loan officers and stuff, and this is what my people are telling me, and that makes us better at what we do. So all this is about, you know, doing a little bit better each and every day. And that's pretty much all we can really try to do here.
That's it, man. I love it. Well, Bruce, thanks again. Everybody, thanks for joining. Couple takeaways. Check out the notes. I'll put some links to JD Power website. I'll link you to Bruce in the notes. And then also, guys, this has been a one-way talk to you all, but we want to hear from you. So after you've checked out this episode, if you've got thoughts on what you would like to see in the data from JD Power going forward that would help you do better for your consumers, send it over to me. I'll make sure Bruce gets it. And when we do this next time, maybe your suggestions become part of the JD Power survey going forward. Thanks again, Bruce.
Thank you. Great seeing you, Brian.